The question of the day on the first of two-day policy meeting is the premise of going along to remove perceived policy advantages of other central banks, Europe and Japan in particular. Is it a good premise to begin with, in your opinion?
Look, I think it is one of the things that goes into making policy, and I think that the risk that the Fed has right now is that DXY might break out to the upside with Draghi reloading. And I think that the Fed has to be careful to not let the dollar run too much during periods so that they don't have unwanted financial tightening. And so they have a balancing act. They have a pretty good economy right now, but they've got some signals from financial markets that suggest that they don't need to be any tighter right now, and they just need to protect against that.
You know, data dependent, it was an unbelievable characteristic during the previous tenure of Janet Yellen. Now, I think it's also gone from data dependent to model maneuvering. I guess in the big picture, is this a one and done, or do you think that market arbitrage, flattening and inverting the yield curve, and all the effects of overseas negative and low rates is something compelling for the central bank?
Look, I think that they're probably going to end up doing 50 basis points cumulative over two meetings. And the best thing that they could do then would just take a break and go into the background and see how that sits and hopefully be able to stabilize everything around that. But we'll see what they actually do, how they react.
History says, Marc, that they move in long-term cycles, pretty hard to argue with. Is there ever going to be a point where the Fed's more fluid, where maybe they raise rates, lower rates, raise rates, and it's more fluid? Final thought.
And I think this is probably the turn, and I think we'll probably end up going lower next year as well.